Good day, everyone. Welcome back for another episode of the InvestorKit podcast. And today's episode, we go deeper into the topic of commercial property. I'm Arjun, your host, and I'll be joined by Chris, our head of commercial, and a special guest as well, JP from Simplicity Finance, and an absolute specialist in the commercial space. So, we talk to different finance professionals on this podcast in the past, but very few, if any, on this show have come up purely and very much specialized on the commercial space. So you'll definitely want to hear from JP today. And you'll notice that commercial is starting to become more of a popular topic on our podcast. And each month we want to ensure that one of our episodes going out is focused on the space because we've noticed it from aspects of cash flow that people are chasing in their portfolio to taking scale to the next level. And because as a business, we're now over 5 years in supporting many people, our clients are going on that journey together with us, where they're going from building a solid base of residential properties. Then they're starting to go all across the country on residential properties and be quite diverse. And now they're looking back 3, 5, 7 properties later and saying, I'm almost there. I need one more home run to get me there. And the cash flow home run is what I need. And commercial property has started to become much more of a feature in how we've supported many investors to get to their passive income goals. So it makes sense to make sure you're as well informed as possible on commercial, because there's no point jumping into these decisions, scaling portfolios this way, unless you yourself are informed and are able to feel comfortable about where you're headed, know about the pros, know about the cons. And so what better way to start that than some of the last episodes that we have? If you haven't already checked that out, go check it out. It's on the tips, pros and cons of commercial property. And Chris, our head of commercial, featured heavily on that one to dive into it today. Dive into it on that episode. Today, we'll be diving into finance, because finance itself is the absolute critical piece to scaling a commercial property. Because whilst one commercial property can make a big difference, it's not going to do everything for you. And sometimes you'll need to look at it from a portfolio level and start to think of multiple commercial properties, different entities, structures. And to do that, you need to consider financing, you need to consider finance structure. And what better way to do that than get into it with JP from Simplicity Finance. So JP, welcome
Thank
on,
you.
my friend.
Thanks, Sergeant. Thanks, Chris. Great to be here.
My friend, Simplicity is no small player in the commercial world. Over $4 billion in terms of settled loans in commercial finance since 2017. And I'm sure that number's been rising since I read that figure out. Could you talk to us a little bit more about Simplicity and perhaps the commercial experience, because the depth of it is very unreal. And I think few people out there recognize just how deep you are in the space for commercial and how different it is in comparison to the everyday broker.
Absolutely. No, thanks again for having me. So, so 1st of August 2017 is when we started the business. We actually, my business partner Matt and I, when we had the kind of the genesis to start Simplicity, we thought to ourselves, look, we'll go out and do what every other kind of broker is. We'll do a little bit of home lending. We'll do some equipment finance. We'll do commercial. We worked out pretty quickly that we weren't experts in those other spaces. We were pretty rubbish. I would say that the compliance side and the resi is just not really kind of what we were looking for. And so we went really kind of totally laser focused on being the best commercial broker that we could be. So fast forward 6 years. Look, we're on run rates to kind of go north of 1.5 bill this year, which will push us into the 5 bill since inception. We've got a couple of offices here in Sydney, one in Melbourne, a couple of staff in Brisbane. It is everything that we live and breathe. So I think the one kind of learning that we've got, and probably a lot of brokers can't say this, unless you're actually in commercial every day and kind of talking to lenders and sort of seeing what's happening in the market, you aren't across what's it's a very, very fluid kind of it's a very fluid market. So you really need to be in there every day. Like if you're doing say 70% resi and you're doing a little bit of commercial, you can't be across all of the lenders that we're dealing with.
Well, mate, I mean, when it comes to that, that's a great review of it from like the broker landscape. When it comes to the customer and them seeing resi versus commercial, what are some of the biggest differences that you could point out to someone when they're first thinking of, okay, I'm about to go look at commercial finance. I've done resi finance before. How different could this be? What are some of the large or high level differences you see?
Yeah, so As far look, some of the differences have kind of they've almost realigned themselves to be. They look similar these days as far as LVRs and things like. Historically, when you were talking about resi, like a resi house, you might have been doing kind of 80, even 90%, or even maybe 95. Those were kind of LVRs that you would never ever see in the commercial space. There are a number of lenders now that are doing kind of 75, 80, 85% against some of these properties. So that has kind of that has kind of converged as far as the space is concerned. But the risk profiles, and I'm sure in some of your previous podcasts, they are really where people need to be across what's going on. Like it's significantly more difficult to find a tenant in a commercial property if you lose them compared to a resi property. In resi at the moment, I'm assuming it's kind of a couple of percent vacancy rates in a lot of these markets.
Well, not
Whereas,
not even
say,
that these days, man. It's tight, right? Like in Resi.
you have five to 10 people lining up at every open house. Whereas, say, in Melbourne, there are pockets of 15, 20% vacancies across office and maybe in some asset
Whoa.
classes even more.
Wow.
So
Unreal.
so you might sit there with a property. You've got to really understand if you're totally 100% reliant on the income and you wouldn't be able to survive if that income disappeared. It's probably something that you might consider maybe kind of thinking about when you do have diverse incomes. And I know you guys talk about portfolio and spread of incomes and things like that. So it are they're those types of things, and it comes with, like, there are other costs. You probably can't necessarily manage it yourself. Whereas probably if you had one or two or three resi properties, you could probably try and manage it yourself if you really felt like it. But there are so many other considerations in a commercial property that aren't it's not as standard or streamlined as kind of a house or a unit would be.
So, JP, just to give you an example, we have clients now that have acquired 3 or 4 residential properties, and some of them are also considering commercial properties now. And in terms of those costs, so LVR plus costs, say for a $1 million commercial property, for argument's sake, what sort of LVR plus costs would they require for a $1 million property?
Yeah. So
Commercial property.
if you're so you can probably look at there's almost markets within markets as far as lending is concerned. So when you consider a commercial property and you're talking about kind of driving for the cheapest rate and kind of getting the best terms and structure for yourself, you would want to at least have 30 to 35% of any kind of purchase available. So 65 to 70% as far as a loan is concerned, and then kind of 5% of costs, as much like a resi property. So stamp duty, legals, etc. If you're kind of you have less of a deposit and you're happy to pay a little bit more on interest because there's other reasons why you want to buy that property, there are sort of non-banks that will play in the kind of the 80 to 85 space if you need to be there. The people like lenders like Think Tank and Pepper and things like that will do those on kind of lease doc, low doc, full doc, whatever kind of basis you're on. There are lenders that kind of cover those spaces. So if you look at, say, SMSF, like if you're talking about maybe potentially that $1 million property going into an SMSF, that's probably that's where a lot of people have a lot of deposits kind of saved up because they've been working in their same role for a number of years and they've built up a few $100,000 there. That also then works. LVRs can be kind of that 75 to 80. But the interest rates tend to be a little bit higher and a little bit more restrictive around what it is that you can do.
What about those specialized assets? Like I've seen somewhere, there's these ones where the deal's killer. I'm talking like a car wash and it's like a 10-year lease and everything looks great. Lease increases. The car wash has been someone that your dad remembers going to. I remember going to. Everyone's just like, it's always been there. And then the banks, for some reason, don't always match what you see and feel the strength of the deal is.
Yeah.
What are those LVRs there when you get to specialized stuff?
Yeah. So when you're looking at car wash in particular is an asset that it's almost like the plague. Just those drive-throughs, for some reason, lenders just don't like them. And I think it's because the alternate use for something like that isn't as straightforward as a warehouse or an office. You can't, doesn't appeal to the wider market. So if you're looking at say a car wash with a major bank, you're probably at 50, 55, 60% at best. Childcare is probably something that is a little bit better than that. Boarding houses, again, probably specialized again. So those kind of asset classes, you probably want to at least have 40 to 45% deposits for any of those, including costs. So, but like you said, you might get really favorable terms on the lease. You might get a really long tenure. There might be reasons why you say, no, I think this is a good bet, but it's for if you're kind of starting out, like if Chris is if you're looking at a customer that might say, okay, I've got 5 resi properties, I now want to go into commercial.
Mhm.
I would probably steer clear of kind of anything that is a little bit left of center.
Gotcha. It's a really
wash
good
is
point.
not. Yeah,
Yeah.
car wash isn't really where I would start.
Specialized assets is a good point, right? Because people also realize now, hearing these numbers, the biggest word I took out from what you said was it's the multi-use or lack of it, right? When you're talking about
alternate use.
Alternate use, right? So this is a big thing for investors who are thinking, they see all these commercial properties out there. Who can you imagine, right? Because whilst retail premises, they think, oh, do I really want to be in retail this time? Let's hold on a minute. Retail just isn't retail, right? That retail premise could be a food store, could be clothing, it could be a medical practice is on the same retail strip, right? It could be the lawyer's office, the accountant's office. It could be the pharmacy. So you see that one premise can be so usable that don't get scared off with the word quote unquote retail. What's that tenant? Who's using it? And you've explained a great point where the deal looks amazing, but hey, come up with a 55% deposit on a 4 mil childcare, not easy stuff, right? Or 45% deposit or a 30% deposit even. So, man, that's really good to know on those specialized assets. Chris, I know you were keen as to pick JP's brain on one particular type of finance.
Yeah, so lease stock loans, JP, would you be able to take us through a possible scenario or a recent scenario that you've done with lease stock loans? Maybe some pros and cons, or just any light you can shine on that?
Absolutely. Look, lease stock was really, really popular over the last kind of 3 to 5 years as rates were kind of in the low 3s, 2s, 4s. Kind of, it was you could really make a deal work quite nicely just on the rental income. Today, it's a little bit more difficult, but in effect, what you're looking at here is a bank will take a property in isolation. They'll effectively ignore everything outside of that, with all your other debts, all your other commitments, and say, can I service a loan based on the rental income alone? Considerations will be what the interest rate that they're charging their loan at, how many times over that interest is covered by the rent, and how long that tenant has got to go on their lease. So if you're looking at, say, major banks, a number of them, Westpac and sort of NAB, they'll do a lease stock product. They'll require 2 to 3 years left on the remaining lease. They'll require a 1.5 times ICR. So how much the interest is covered by the rent on a standalone basis.
1.5 times is pretty solid, right, JP?
It has to be pretty good rent to get to that. So what you're finding with lease stock is when interest rates were low, you could probably get to 60-65% of a loan. Where you're looking at now, it's probably 50-55. The rent, because the cap rates have kind of stretched a little bit, and now you're kind of looking at 6.5 for some of these properties. It is more difficult to show it, and interest rates at 6.5 or 7, like it starts to become a little bit more difficult to kind of get a reasonable gearing on a lease stock product. So it has lost a little bit of its luster. It's still definitely available everywhere, and you might even consider like, I've got a great tenant who's been there for 10 years, but they won't sign a new lease. You can go to someone like an ING, where ING says, look, as long as you've got 12 months left on your lease, there's lots of different kind of ways to look at those properties.
Right. So it's an easier form of lending. It ignores your other sort of debts. It's available everywhere. It does entail that it's a lower LVR. And the interest rates could vary as well. So there's sort of the pros and cons.
They can vary. Look, even the non-banks, the La Trobes, the Peppers, they all do a lease stock style calculation as well. But obviously, when they're taking their calculations on a higher interest rate, it means you can borrow a little bit less. So there's just a bunch of considerations to have. So if you can do a full doc basis, obviously means you'll end up with a little bit more gearing. You look like all sources incomes, like might be your wage, might be your profit. But if you don't have any of that, or you want to do it as a standalone, is definitely a real option out there.
So in terms of interest rates, sorry, JP, in terms of interest rates, what are you seeing typically in the market at the moment? I know they vary. I know they're different with different lenders. But just say a standard, industrial unit with a big major four as compared to, similar asset, but with a specialized bank or a non-bank lender? What would you
Yep.
see there in terms of interest rates?
So if you're like, and it's LVR driven,
Hmm.
but let's say you're kind of, you want to be at kind of 60, 65 on an asset like that with a major bank. You could expect to be somewhere in the early sixes, and that's about that's probably anywhere between a 1.7 to 2.25 margin over the cash rate. So it's generally somewhere there. So if you're trying to run your numbers on budgeting and things like that, and you wanted to borrow from a major bank, I'd probably run my numbers at maybe 6.25.
Okay.
That's pretty good because it's
Mm,
quite comparable to residential, and that's a
mm,
myth that you're busting. Because many people go into commercial thinking, "Oh, they must be charging, big boy interest rates. It's going to be another 1%, 2% on top." It's not the case, right? When you start
No,
to
no, no,
break it
no.
down.
Yeah, gone are those days. Like Arjun, during when we were talking about 2% interest rates and stuff like that, rates on commercial were below some of the resi products
wow.
out there. So
Wow.
yeah, so it is that. But what you also need, there are significantly more transaction costs to get in and out of these loans. So there are like lenders aren't really charging $300 annual package fee or $600 establishment fees. They're generally 0.25, 0.5, 1%, 1.5% for some non-bank lenders. So there are some transaction costs that you need to consider, that's they're really costs that the lender passes on to kind of make up, because there's quite a lot more analysis that goes in on their side as far as when kind of getting one of these loans on the books.
Well, when it comes to those commercial loans, am I right in saying that sometimes the bigger the deals, unlike in residential, where you don't, like a 500K loan can sometimes get treated the same as a $5 million loan, but the bigger deals can get preferential service as well, right? In terms of pricing or terms or fees. Is that true? And how does that work in the world? Because some people might be scared of taking on those bigger deals, but I find in commercial, when you buy bigger properties, they end up getting better, and when you get bigger deals for financing, does it get better?
Uh, it in the banks, yes, they like, obviously the bigger the quantum of debt, it tends to get a little bit cheaper. In the non-bank space, it tends to be the reverse. The lower the loan amount, so there's a kind of a sweet spot for a non-bank. It's kind of up to that 2 to 3 million space. That's kind of the really nice purple patch for those guys. I think that's where they have warehouse funding, and so their loan costs are lower. When you start creeping up to the 5, the 10, the 15, the $20 million mark, the price starts to get a little bit more expensive because their funding costs get a little bit more expensive.
Yeah,
But
good to know.
in the bank side, yeah, absolutely. The more you're buying, the better the rates and terms generally get on a bank style deal.
If you're a residential investor tuning into that part there, this is where many people get the mistake on the transitions. When you're in residential, you often find that we can make smaller deals make much more sense in certain cases, because your rental yield on $2 million houses in comparison to 4 500 or 650K houses, big differences. And you get more
Absolutely.
diversity, you get more yield, you get even tighter vacancies as well in some cases. And so what happens is that your position and your scalability is something that becomes better. But then what ends up happening is that you shouldn't be going, as JP's pointing out, with the same mindset as a commercial investor. Because if you're going to transition to commercial, suddenly the deal sizes for the main banks, as JP's pointing out, when he starts to look at the deals, he can get you sharper interest rates. We can get you higher quality deals. We can get you longer leases. We can get you more stable tenants with the deal size that increases. So you kind of have to have a small switch there. JP, when you're also talking through finance, this is also where I noticed something I've seen in commercial side, and this is me and Chris have started seeing it too, is the sophistication of structure starts becoming a lot more important and a lot more used, rather than having all these commercial investors and some personal names and some structures that are, husband, wife, or partner, or by yourself. Everything starts to be going into companies, trusts, and other things.
Absolutely.
Why does that start to be more apparent in your world when you see the financing like that?
Yeah, yeah, absolutely. Look, the majority of the transactions that we are doing in our space, I'd say at least 95% would be sitting within a trust or a company structure. That is for mainly for risk mitigation purposes, and also for the ability to kind of pass through that income down to the beneficiaries of a trust. So there are structures like a unit trust where you're able to maintain the kind of the land tax threshold and discount. So there are reasons why people do it, but it's mainly to kind of isolate these assets because they are large assets. So they tend to become kind of cornerstone family assets to pass on to children and siblings and all that. They isolate it from the risks of any part of maybe their trading business or any other aspects of their life that they think it needs to be kind of isolated, so that in some sort of insolvency event or maybe some sort of risk event, like you could own a childcare center and a child could die there, and then if that center goes under, you need that to be stay out of your personal name and kind of isolated across to the left where someone that is sort of coming after you can't access. So there are reasons why people do it that way, but there's also the taxation benefits to it. Tax in a company is significantly lower than tax in your personal name, and there's other reasons and considerations there, but it tends to be kind of an asset protection strategy that drives a lot of this stuff.
Right. Thanks, JP. Many investors transitioning to commercial are resi equity rich, but cash poor. How do you help these investors make that transition?
Okay, yeah. So Chris, where someone has significant kind of equity within their residential portfolios and they're looking to access that for say a commercial property purchase, or maybe they're looking to do, I don't know, it might be a small duplex loan, or they might be looking to kind of dabble in some other part of the market.
Mm-hmm.
We generally like to keep all of these assets separate. So what we would come to a borrower with and say, look, it is best to raise the debt in whatever cheapest form it can be done across those assets and throw it across as equity. We rarely like to cross or throw properties together because you limit your ability to be flexible and to do different things. So if so for argument's sake, say we're looking at a client that is doing a subdivision in the Goulburn area, and they've come to us and said, look, we've got these 3 unencumbered properties here. We'd like to throw those in as security. And we'll say, well, yeah, we could do that. If it was my transaction, I personally wouldn't do that. One, because a construction loan on a subdivision is going to be significantly higher interest rate, higher risk. What we would do is we would raise you some term debt against those assets. You then draw that out as is required for this project, and then we will borrow against the project at a lower level and keep all the costs down. So it is all about kind of just trying to maximize the cheap part of the debt piece that we can get, and in many cases that might be raising home loans against those properties and tipping it in across into the purchase. Now, where you might consider that, you might say, okay, well, we can, if you're buying the commercial property in a trust and you want to maximize the amount of interest deductibility that you've got, you could then get that home loan over there against that equity in those properties in the trust as well. So then the accountant will just do a nice little book entry, all of the numbers. You basically borrowed 100% of the commercial property plus all the costs. You've got a great deduction for that commercial property for kind of future use.
Awesome, mate. That's good to show us that separation and how you can still make that equity work, mate. On the commercial side, the loans are obviously bigger, but looking at the screen behind you, the trophies seem to be bigger for commercial guys too, huh?
Yeah, that's yeah. We've been fortunate. We've had a good run. 2023 was very good to Simplicity. So yeah, I took out Australian Broker of the Year, both commercial at ABA and AMA. So yeah, we were very fortunate. So, but to be fair, like a lot of the success is owed to the staff within our business. So it's definitely not one person, but yeah, the trophy cabinet is a little bit full.
Well, mate, this has been great to understand, that resi equity usage, look at lease stock loans, understand them a little bit more. Deposits required, specialized assets, and even just the resi commercial finance basics. I know that we're going to be catching up more often with you, mate, and do more deeper dives into scenarios, situations, just to help people really uncap it. But this was a great, teaser and also taste for the world of commercial and how resi investors making that transition can make sure they can split their focuses and start to actually see commercial in a different view rather than thinking of my resi finance approach is the same way. But if I was to take just 30 seconds to summarize, because I think when when I summarize, it's also for my learning, because I learn a lot from you on this call as well, mate. So with resi and commercial, firstly, we want to realize that the commercial deals, as they can get bigger, the funding can start to become sweeter as well. The second thing is there's no myths around how expensive they are in terms of the finance. They're very comparable to residential, and sometimes with the right deals, they can be cheaper. Lease stock loans do exist. They can mean lending and scalability of a portfolio without servicing constraints. But in today's interest rate environments, you're just going to need to make those deposits meatier, which does in some cases limit the scalability. Because if you're putting 40, 50% deposits down on every place, trust me, whilst yes, forever infinity finance sounds great, to put together 50% deposits on a deal, even for the wealthiest, is not easy. And then lastly, when it comes to investors transitioning, you got to consider the costs of application, valuation, breaking it down further, not just hey, everything's free like the residential world, and realize that as you're making that transition, you can start to also look at residential equity, unlocking that to boost your commercial property portfolio too. Mate, did I get that summary right? Did I miss any key points you worth highlighting?
The only thing I'd leave with the listeners and for yourselves is just plan early. If there's something you're considering or you're looking to do this, get in touch with someone that knows what they're doing. Kind of they can give you some advice around structuring what you can afford, what your deposit is going to be able to kind of get you, just so that you're not wasting time looking at properties that either are outside your budget or wouldn't work from you from a risk standpoint. What those risks might be. So yeah, just plan. I think is the best thing to think about. Like get involved in it early, have the conversations early. Because like you said, decisions are driven by how you can finance a property is probably key.
Beautiful. Well, JP, what's the best way our listeners and watchers can get in touch with you, mate, on the finance front for commercial?
Yep, we're available at simplicity.au, so all our details are on there. But yeah, appreciate you getting me on.
Awesome. Well, that's it from another episode on InvestorKit podcast, and joined here by JP from Simplicity Finance and Chris, our head of commercial at InvestorKit Buyers Agency. If commercial's been on your mind and you're thinking, I'm starting to get an understanding of the differences on resi and commercial from the last episode, and now even finance and getting that deeper, and you're after expert help to start to scale or begin the journey of commercial property, just reach out to investorkit.com.au. Our team can have an initial discussion, which is totally free and just helps you understand more about the world of commercial. To give you some insights of some of the deals that we focus in on as a team are things with 3 years or more on leases remaining, so tenanted assets. Typically from that sort of 1 million all the way even up to $10 million deals, and then looking at areas where we see strong demand in the industry, strong strength in the tenant themselves, and also asset types across the locations in Australia that we're liking that are destined for growth, and healthy cash flows with stability. So that's our core focus here. To learn more, it's investorkit.com.au, and catch you on the next commercial episode. Thanks again, JP.
Thanks, guys.
Thanks, JP.
Appreciate it.